Happy trading, everyone. This is Ron William, dialing in from MIG Bank based in Switzerland. I'm very excited to be here with you today to discuss dollar-yen long-term structural change now and into the future. Now, before I go into the actual presentation, just want to go through the traditional contact details should you have any questions, or maybe you would like to follow up with me on various matters. My email address is r.william@migbank.com, and there are various social media websites that you can catch us on. There's an MIG Bank Facebook. I have my own Twitter account, rwilliam77, and of course you can also find my details, Ron William, on LinkedIn. Last but not least, there's a very good and growing blog on forexstreet.net, which is part of FX Street, which I update here and there. I'll be more active on that in the future. So that's just the contact details and social media should you wish to keep an active real-time contact with us here at MIG Bank. Okay. Now, I'm going to start by going into the various areas that I specialize in and have done. I've been in the market now for well over 10 years. During that time, I've worked with various consultancy firms, providing intraday and multi-day, multi-week, and even more long-term trading recommendations and research. And most recently, before actually being a technical strategist here at MIG Bank within the research team, previous to that, I did work at the global media company Bloomberg, based in London, but covering much of the Europe, Middle East, and Africa region, visiting various institutions and helping them with trading strategies, and of course also developing new indicators and ways of looking at the market as well. So there's a lot of research and development there. Now, during the 10 years or so that I've been in the market, there are three areas that I have specialized in all that time. The first area, which is probably the most important area to me, is market cycles. And this is basically my roadmap. Every day when I look at the market, any time frame, it offers me a roadmap between A and B. So think of yourself as driving a car outside somewhere and you're trying to find your way. And sometimes the best perspective you can ever get is a big perspective from a map that navigates the twists and turns that you may actually find yourselves in when you're driving or even trading and investing in the markets, the volatile markets that we're in today. Now, a lot of these cycles are basically cycles of past history, trends, and patterns, and very much the psychology that underlines the market. I also look at economic cycles, which is basically looking at the intermarket links, the correlations between various asset classes and intermarkets with each other, which often gives a kind of internal perspective into the market when you're analyzing it. So that's market cycles in terms of time history cycles, but also economic cycles. The second area that I focus on is Japanese candlestick trade setups. Now, this is within the context of general chart patterns, but very much one of the areas that I have covered in depth and continue to do so is Japanese candlestick patterns. These are very timely signals. The majority of them are reversal signals, and so they can be quite useful for volatile markets where a lot of price swings are generated. Also, the reversal signals can take anything from 1 to 2 or 3 trading sessions. That could be a few minutes, that could be a few days. So it can be a very fast trade signal to use. And then, of course, that helps give you an edge in the market, maybe over other people who are trading. Last area, which is also very important to me, is the more kind of advanced side of the technical indicators that one can look at. And one of the areas I focus on quite a bit is DeMark indicators. These were developed by a very well-known influential investor and trader called Tom DeMark. most people in the market have seen his work. He's been developing research and trading strategies for well over 40 years, and he advises many of the hedge funds and key people in the market. During my time at Bloomberg, I spent some time working with him in terms of developing the product at Bloomberg, and I came to know his indicators and use it every day now in my trading ideas. His indicators are basically focusing on reversal points in the market, and it's looking for turning points, exhaustion points in momentum, and they are known as market timing indicators. I did give a presentation on this on FX Street a while ago. And then, of course, within advanced indicators such as the market indicators, I have my own proprietary indicators that I continue to develop, especially with all the research and development work that I did at Bloomberg. It encouraged me to continue that work afterwards once I got back into the market. Okay, so these are the three areas: market cycles in terms of time history cycles and economic cycles between different markets, the correlations. General chart patterns, but specifically Japanese candlestick patterns, which are good for timing. You can get reversal signals in volatile markets in the space of maybe 1 to 2, 3 days, so it can give you an edge over other traders. And then lastly, advanced indicators such as DeMark indicators made by Tom DeMark, but also other indicators I look at as well. Keep in mind, DeMark indicators, which I will feature in this presentation on dollar yen, does focus on reversal points in the market. Okay, now I just want to ask the question. I ask this in every single webinar that I've given on FX Street, and we've almost been giving about a year's worth of webinars every single month for almost 1 year. I have been giving webinars here from MIG Bank with FX Street, and we've covered many educational trading techniques, but also quite a bit on market outlooks. And of course, this year has been a fantastic year for discussing market themes. Now, the question I always like to ask the audience, we have almost 100 participants here in the webinar today, is where in the world are you dialing from? I mean, one of the points I always share with the FX Street team is these webinars here at MIG Bank with FX Street are truly becoming global. So if you could please just share with us the country that you are originally from or calling in from. So I'm seeing Germany, Canada, Arizona, London, Germany, UK, Canada, North Carolina, USA, Philippines, USA. This is wonderful. Singapore, Africa, Portugal, Hawaii. Quite a big mix. Texas, Kuwait. Please continue. I mean, I'll go through the presentation. Mexico, and if FX Street just could quickly snapshot this fantastic, rich list of countries around the world where people are tuning in to attend this global webinar here at FX Street. Belgium, China, Scotland. Truly diverse universe of attendees from around the world. And I must say, it is really an honor and a pleasure for me to be here presenting these ideas to you. And I really hope that we can make this an interactive session where, I mean, I'll go through my trade ideas and trade analysis, but I would love to hear from you in terms of what you're thinking about the market, especially with such a volatile week like this week on dollar yen and, of course, all the other markets. Okay, last few countries I'll mention, Belgium, Scotland, and South Africa. So we have a really, really big number of countries there from different parts of the world. Welcome to everyone, and Dubai as well. Welcome to everyone. I can see a few familiar names as well from previous webinars. And if some of you are new to this webinar, if it's your first one, welcome to you. I hope you enjoy the session. Okay, so this is what we're going to cover in the time that we have remaining. 3 parts to this webinar. First part is market outlook. I want to get straight to the bottom line and talk about the latest Bank of Japan intervention and key price trigger levels so that you can note these down straight away and have key levels to watch out for on dollar yen today and then in the days and weeks ahead. Then I want to talk about global risk appetite and how that has been impacted this week, triggered by the dollar-yen move, but also, of course, by what's been happening in Europe with the heightened turmoil in Europe, referendum in Greece, and so on. Lastly, in part one, we want to discuss what do long-term cycles tell us about dollar-yen. As I mentioned at the start, cycle analysis is a very key part of what I look at, but I'm just going to kind of simplify it in a way that we can all just look at the basic trends, long-term, medium-term, and short-term, and get an idea of what might be happening to dollar-yen at the moment. Part two, I want to spend more time talking about external influences because, I mean, whichever way you look at this, dollar-yen is one of those pain trade markets where just about any type of influence has impacted it. I mean, of course, we have the technical influence, we have the economic influence, we have the event shock influence such as earthquakes, and now we have multiple central bank intervention influence. So external influences is a key area that I wanted to dedicate in part two, where we discuss central bank interventions. I'm going to take a quick glance into history at a few central bank interventions by the Bank of Japan and the Ministry of Japan, just to see how that has impacted the market, how successful interventions have been in the dollar-yen market. Then I want to discuss event shocks, so the earthquakes in Japan, Kobe in 1995 versus Tohoku earthquake, and just say a little bit about psychologically, what do these big catastrophe events, unfortunate as they are, what do they do to the market, generally speaking? And then last point within part two is safe haven flows. Everyone speaks about Japanese yen as a safe currency to invest in during uncertain times. And certainly that's been part of the reason why we've seen an increased speculation in Japanese yen reaching record highs time and again. So I just want to open that question up in terms of, how long will the yen maintain its safe haven title? Part three, high probability strategies. This is a very kind of brief segment. I wanted to make more time for this segment to talk about a few areas that might be useful to you in just managing the risk when you're trading such unpredictable and volatile markets such as the Japanese yen recently. But for now, I'm going to give a quick overview of a step-by-step process for analyzing markets generally, but especially dollar yen. Something I call pyramid analysis. It's just a quick way to analyze markets in a solid way. I want to make one or two points about the options market and how that might be useful for markets such as dollar yen, which are very volatile and sometimes not clear as to which direction it will be moving in the short to medium term. And then I just want to make a last point about other relative Japanese yen opportunities, not just the dollar, but what other currencies might be interesting against the yen. I'm only going to make one suggestion, but I just want to open that question. Okay, just a quick disclaimer that I'm obliged to give legally here at MIG Bank. No information published constitutes a solicitation or offer, recommendation, or advice to buy or sell. And just last point, information, this is just for educational purposes and nothing else. You can read the rest in the recording. Okay, so the point here, I just want to start with what happened late on Sunday, a few days ago. The Japanese Ministry of Finance intervened for the third time this year, 2011, with a record amount of liquidity of 7 trillion yen, the largest unilateral intervention in terms of liquidity since 2003. So, I mean, certainly the government and monetary officials in Japan are getting even more serious and perhaps frustrated about the situation with the strong Japanese yen impacting its competitive export-led economy. And they've made the point. Japan will continue to intervene until satisfied. And then that's one of the key statements that they voiced over the last few days. Just letting the market know that they will come in again. And this is a key point that I want to make. This isn't another intervention, and that's it. There are likely to be more to come. And in my opinion, there may be a need for that. I'm not so sure as to whether this intervention, the last one, the third one this year, is the one that really takes us up on dollar yen and really reverse the sentiment in the market, which has been very positive on the Japanese yen. So people buying the Japanese yen, partly looking for that safe haven trade and partly just on the back of short-term speculation. Now, this intervention that happened last Sunday, 7 trillion yen worth of intervention by the Ministry of Finance in Japan, of course, did trigger a further unwind in risk appetite. And this is a point I want to make. It didn't just impact Japanese yen proxies. Here we're looking at dollar yen on an intraday basis moving around 400 pips in a very short space of time. Keep in mind that we had other markets that were impacted, and I'll just show it after this slide here. The key trigger levels you want to keep in mind on the dollar yen daily chart are the ones that we are looking at now. 80, a round level, psychological level that the Bank of Japan is more than likely to be watching very closely. 82, you see the red dashed line probably at the higher up dash line at 83.50, which shows you the high where the actual last earthquake early this year took place. So the key areas are 80, 82, 83.50. These are the key upside bullish trigger levels on dollar yen that we need to be watching very carefully. Now, keep in mind that on the downside, of course, the key level is the post-World War II record low, now at 75.35. We keep on posting new world record, World War II, post-World War II record lows. But the interesting point I want to make here is the market indicators, which I mentioned, which are market timing indicators that highlight key turning points in the market, did actually interestingly signal 3 buy signals ahead of the intervention that we just saw recently. So DeMark buy signals approximately 3 ahead of the new World War II record low at 75.35 just before we saw the intervention by the Bank of Japan. So just keep that in mind just as background information. Now someone's asking, Mike here is asking, some experts propose that Australia versus Japan, Aussie yen, is a measure of risk on, risk off, so risk appetite in the market for equities and futures market. Will the changes you presented change intermarket correlation? That's a point that I'll make towards the end. Aussie yen is something that I do suggest at the very end as an interesting trade opportunity against the Japanese yen. Australia being a very high yielding, high interest rate driven currency, which is generally seen as a wonderful kind of carry trade opportunity against the Japanese yen, which of course is that safe haven, low yielding, low interest rate currency. And whenever you see Australia depreciate versus Japanese yen, that is often a sign of the market reducing its risk appetite in the market. And I believe that we will continue to see unwinding of risk appetite as the days and weeks go on, following this intervention and various other things that happen in the market. So I hope that answers your question, Mike. I think the correlation is maintained, and Aussie yen becomes an interesting trade for the downside. So we are talking about risk appetite in the market. Of course, this has been a very big theme in the market. It's been a two-way binary perspective, risk on, risk off. And of course, one of the interesting points is we've seen what happened in Japanese yen affect all the other markets. Now, one of the key points I want to make here is this is a chart of the Japanese yen index. I don't want to just talk about dollar yen, so Japanese yen against the dollar. I do want to make a point about the Japanese performance, Japanese yen performance against a basket of currencies. So here we're looking at the Japanese yen index. This is an index produced by, I think, one of the big institutions, JP Morgan, where they've just made their composite index of the Japanese yen. And what we see here is, of course, there's this massive uptrend in Japanese yen value. So Japanese yen appreciating since 2008 and even before that, but this is the trend that we're looking at since 2008. But very recently, we're seeing a sharp downside reversal on the Japanese yen index. And the red line you see there is the 200-day moving average. And then beneath that, almost 3-year uptrend line. Both of these points, I think, provide very key target levels on the downside. 138.60 is the 200-day moving average, and then the trend line around 134, and then of course the Fibonacci level, the green level, is the 38.2% Fibonacci level at 130. So I'm looking for Japanese yen weakness across other currencies, across a basket of currencies, and according to this index produced by JP Morgan, I'm very much seeing the Japanese yen depreciate in value to the index value of 130. I just want to say a quick hi to Fernando, a key client of ours. Thank you for making it here, Fernando, all the way from Brazil. There's a question here from another person. How can a technical indicator foresee a move caused by the fundamental intervention? Good question. I mean, it's very hard to foresee when an intervention is going to take place, but sometimes there are various signals that come together at one time, and I'm kind of the view that also some of the central banks out there tend to intervene at key points, and of course record highs, record lows are the most traditional places that a central bank will intervene, partly because central banks want to protect against overvalued currencies. It's not good when they depreciate too much in value or if they appreciate too much in value. So record highs and record lows are obvious places to maybe look for major reversals in the trend and interventions by central banks. But also keep in mind that central banks, in my opinion at least, do look at technicals, and they do look at trends and key levels and indicators themselves. And certainly in the time that I spent, several years that I spent at Bloomberg, we would visit central banks as clients. And a number of them did look at technical analysis and were interested in technical analysis strategies. So keep in mind that most central banks around the world, certainly the big sophisticated central banks, will be looking at technical analysis. And certainly in Japan, a country which has a long history of technical analysis and market analysis, of course, with Japanese candlesticks, Ichimoku, and several hundred years of technical analysis history, I only suspect that many people will be watching key levels in the market. Keep in mind, the most obvious point here is the Japanese yen was at a record high, or dollar yen was at a record low, so that was also an obvious area. Another person's asking, do the government have a target like the Swiss, or are they wanting to push it down as much as possible? That's a good question, and there's been a lot out in the media recently, and I mean, the rhetoric that seems to be coming out of the Bank of Japan and the Ministry of Finance, which seems to be calling the shots at the moment by themselves, is that yes, they are intervening, and this is the third intervention to take place this year, and it was a record amount of liquidity that they intervened with, the highest since 2003. But they are trying to mitigate this overvalue of the Japanese yen through other ways. They are actually directly helping exporters, and they're doing various things within their monetary policy to try and mitigate, to try and adapt to these new environment of record Japanese yen value. So it is interesting to note that not only are they intervening, but they are looking for strategy. Okay, so Japanese yen index, a measure of the Japanese yen across other currencies, appreciating in value since 2008, reaching record highs on this index produced by JP Morgan. But very recently, you can see in the red circle there, it's unwinding from these very extreme levels. And in my opinion, it will continue to mean revert from these record levels into the 200-day moving average and the uptrend line, and then beneath that, 130, which is a 38.2% Fibonacci retracement of the entire bull run since 2008. So Japanese yen index to target 130. Now, of course, the intervention in the Japanese yen has also triggered unwinding across many other markets which represent risk appetite, Eurodollar being an obvious one. Now, of course, Eurodollar, there's many things happening out there that has affected Eurodollar, but just keep in mind that there was a sharp reversal from a 2-year uptrend line taken from June of last year, and that sharp reversal targets 130 in my opinion. Now, keep in mind that this is an emotional bull trap that actually was triggered recently. The big surge up on Eurodollar followed the positive news from Europe last week about the official increase in the bailout fund and the haircut discount of 50% to Greece. But a lot has changed since then. The Japanese authority intervened. That sparked a reduction in risk appetite across many markets, Eurodollar being number one. But also you had even further downside pressure on Eurodollar on the back of this Greek incident with the referendum and the question of Greece potentially defaulting over the last few days. Okay, so Eurodollar, massive reversal from a key 2-year trend line, triggered partly by the Japanese intervention. Second chart is Australia dollar, post-intervention from Japan, turning from a key resistance level. And this is part of a continued kind of distribution top pattern, in my opinion, that will resume lower into parity, that one level, and then beneath that 0.94. So again, another risk currency showing unwinding of risk appetite and further depreciation of the Australian dollar. Last but not least, the equity markets, which of course shares a high correlation with risk appetite trades and Eurodollar in terms of the correlation. And you can see here again a massive reversal from a key level, distribution pattern level, or head and shoulders pattern neckline level. Again, showing that the market will the equity market will probably fall even further over the next few days and weeks. So all of this is on the back of what happened in Japan, but also many other points out there, almost a perfect storm of signals which have coincided at the same time across the risk assets. We have Eurodollar turning off a 2-year trend line, Aussie dollar turning off a key horizontal level, heading down into parity in 0.94, and the S&P and various other equity markets also turning off a major key level within this massive distribution pattern. Now, one point I want to make here, and someone said this about various stops in the market, is that there are many people that are still looking to trade the Japanese yen further lower, or I should say, sorry, many people who are looking to pick a major low in dollar yen. And obviously sell the Japanese yen in isolation. So this is a chart of sentiment in the market. You see the white line is representing sentiment in the market based on the options market. That's the white line. The white line is basically showing you the number of options which are buying dollar yen calls, so that they're looking to buy upside moves in dollar yen, weakness in the Japanese yen, versus people who are trying to sell dollar yen or buy Japanese yen strength. So what this is basically showing you is that the number of people that are actually looking to pick a major low or major bottom in dollar yen, they're looking to buy dollar yen, has reached a multi-year high. And in the option world, we call this a skew, when one set of investors are biased versus others. And you can see here in the red circle that record multi-year skew of people in the market all overcrowding into a buy dollar yen situation. The green line is showing you dollar yen. Now, what this creates is a big problem for the Ministry of Finance in Japan, of course, because it's become an overcrowded trade. And it's becoming a situation where the market is pushing the currency in one direction, yen appreciation, record highs again and again, and the Ministry of Finance and the Bank of Japan are trying to push the market in the opposite direction. So it's this dynamic wrestling match between market forces, investors and traders, and the authorities in Japan trying to devalue their currency. And we've also seen a similar situation here in Switzerland, where MIG Bank is based, where of course the Swiss franc reached record highs, and then the Swiss National Bank intervened and made a similar point about how a strong currency was hurting exporting part of the economy, and so we have this currency war taking place in Switzerland and Japan and various other parts of the world, maybe Singapore next. So keep this in mind. This is what's happening right now. It's a constant wrestling match between monetary authorities in these countries with very strong currencies hurting their economies versus market forces, traders and investors who are just looking to make money. And of course, they're looking to make money in safe vehicles like the Japanese yen, like Swiss franc. Okay, I've got many questions. I'm going to try and just answer one or two. One person saying, your forecast for Bank of Japan will success in yen intervention. I think that yen intervention will actually inevitably succeed, but I think maybe there might be another round of intervention. But ultimately, I think it's the market forces, the demand supply, traders, investors in the market that will ultimately reverse the trend in the Japanese yen, and specifically dollar yen to the upside. So I'll mention that in my cycle analysis, which I'll go into in a few moments. Next question is, you mentioned this new situation regarding Greece and its possible default now in referendum. If Greece do default and decide to leave, wouldn't that be yen bullish, as markets will be look for safe havens, at least in the very short term? Possibly, but it's such a big wild card, it's hard to price that into the market, and potentially I think that will be more positive to other currencies in the market, such as the US dollar, and I'll mention that in the following part of this presentation. Okay, I just want to make sure that other questions are answered. Okay, I'll move on. So the key point behind this picture here is just saying that Japanese yen trade has become overcrowded. Many people in the options market are looking to buy long call options, so they're looking to actually buy dollar yen, and they're basically trying to speculate whether dollar yen is making a major low. The problem for the Ministry of Finance now in Japan is that they're wrestling against the market forces, which are basically pushing the currency in the opposite direction that they would like it to move. Okay. Now, I'm going to go into cycles, and some of you who've seen my previous webinar presentation on the US dollar will remember this slide. It's just a very simple and fast way to understand why cycles matter. This is a picture of a tidal wave. I like my pictures. They help tell a good story. Basically, if you imagine this tidal wave being very important and affecting you as a sailor or a swimmer, being right in the middle of it, it's important to be aware of the long-term cycles because they do affect medium-term and short-term cycles. And so this tsunami, which someone, Nice, just correctly called it, is a long-term cycle. And so here, if you just think of these cycles as, think of them as triplets, 3 cycles that appear at any one time. One is the long-term tidal tsunami cycle, which can be 1 to several years. Second one is, think of the waves in the sea, and which tends to be several weeks to several months. And then lastly, ripples. Again, this is the analogy for the sea and the ocean, which shows you multi-day to 3 weeks. And this is used for chart timing purposes. Now, there isn't so much time for me to really focus on this, but just keep in mind cycle, and there are various ways of looking at it. But keep in mind that there are 3 key cycles: long-term, medium-term, and short-term. And I'm just going to focus on the long-term now. I also do agree that a second part to this webinar would be good, and I'll leave that to FX Street to consider. I'm more than happy to do another follow-up webinar on this because it is such an important area. Now, what is important to everyone here is this is my current view of dollar yen within the long-term cycle. I currently believe that dollar yen is at the very bottom of its previous cycle, down cycle, and is on the cusp of a very long-term upcycle in terms of dollar yen. So US dollar appreciation versus the Japanese yen, and just general broad depreciation in the Japanese yen. This is what we're likely to see, the green arrow pointing up, and that's just a very kind of simple, fast point that I want to make about the position of dollar yen. We are at the cusp of a major uptrend cycle on dollar yen, down cycle in the Japanese yen, so Japanese yen depreciation and a decrease of safe haven flows into the Japanese yen over the medium term to long term. And I'll come back more to that. Now, just that question here about the US dollar, my view has been for some time, ever since early this year, that the US dollar index will likely gain by up to 30% over the next 6 months or so. I will talk about that. I believe that the US dollar will gain a lot of the safe haven flow over the next few months as things become more uncertain. But just keep in mind, long-term cycles, dollar yen is roughly at the major bottom, about to approach a major upcycle. Okay, now this is the long-term cycle here on dollar yen. This is a chart which most people probably don't look at on a regular basis because it's a very long-term chart. This is dollar yen as far as back as 1970. So when dollar yen actually first floated on the currency market in 1970, this is what it looks like. And of course, it's a massive downtrend, Japanese yen appreciation and dollar depreciation. But what it shows is basically, if some of you are aware of Elliott wave is a fantastic way to basically isolate psychological patterns in the market or long-term cycles in the market in a fractal way. And what this shows is a 5-wave sequence. Elliott waves generally have impulsive sequence and then corrective sequences. This is shown to be a 5-wave long-term downtrend sequence, which with the number 5 signaling a major bottom in the currency. So this is basically my roadmap, my cycle roadmap for dollar yen since the 1970s, showing that there is a major low in dollar yen to come. Now, just on a very simple basis, if you just look at a weekly 5-year chart on dollar yen on your own trading systems, you'll notice that the currency has been reducing its volatility within this very strong pattern, wedge pattern, which is being squeezed into that late stage of the apex. Now, in Elliott wave terms, this is also called an ending triangle pattern, and is often a sign of a massive reversal within a long-term cycle. So we are right at the moment approaching a breakout zone on this long-term pattern within this cycle. And I would really encourage everyone here to look at this chart on your own charting systems. Okay. Now, we've covered part 1, market outlook, just looking at Bank of Japan intervention, key trigger levels. I've mentioned the point about the options market and how that shows that there are still trades out there which are hanging in the market. And we've just quickly kind of mentioned long-term cycles and asked the question, what does it tell us about dollar yen? And what it tells us about dollar yen is that there's a massive reversal to the upside, favoring US dollar appreciation against the Japanese yen. Keep in mind, it's not just US dollar appreciation. It is also Japanese yen depreciation across many other currencies, but specifically the US dollar. Okay, we don't have much time to go, guys, so I'm just going to possibly end on questions and then maybe resume at a later date. So any questions? I'm going to answer some questions now and maybe save this webinar for a part 2 next week. Okay, so someone's asking here, Ron, none of the interventions. Yeah, we can do part 2 tomorrow. I think that would be great. I'm happy to do part 2 tomorrow. If everyone here can sign in tomorrow, I really hope that all of you can make it tomorrow. I'm happy to follow up. Perhaps I can answer some of the questions then, and we can do a wrap today. So really want to kind of thank everyone for making it to this webinar. We'll do our very best to make a part 2 tomorrow. I should definitely be there, and I hope that you guys can make it. Keep in mind my contact details if you want to keep r.william@migbank.com. I really encourage you to kind of send me an email with any questions ahead of tomorrow's session, just so I can maybe prepare to focus on your key questions. So the questions that are asked here today, perhaps FX Street could maybe send me a screenshot of some of the questions that have been asked here, and if maybe some of you could send it to me individually. Thanks very much, FX Street, for giving me this opportunity. I look forward to coming back tomorrow. And I'll end off on this one proverb mantra of mine: enlightenment to realize knowledge. I really, really enjoy sharing knowledge and learning from you guys. So please, I hope that you can make it here tomorrow. And look forward to the next session. I think that'll be coming up. Thank you very much. So I'll get the screenshots tomorrow. Thank you very much, FX Street, and thank you very much, audience, for attending. We've had almost 100 people here, so please, I hope that we can get the same number, if not more, for tomorrow. Thank you very much, everyone. See you tomorrow.